Hello, Accounting 230. I had to scrap the Chapter 12 video I made earlier. I failed to show the PowerPoints. I was babbling into an empty screen, and that video had to go. So we're going to try it again, and hopefully this time you can see what I'm talking about. So here we go. Can you see that, everybody? I sure hope so. If not, I'm wasting another half hour of valuable time I could spend reading my sports books. Anyway, statement of cash flows is the chapter 12. And when we talk about cash flows, we like them to be positive. I bet you didn't know that, right? Companies, generate cash for the same reasons we do. You pay dividends to people, expand our businesses, buy things. I think we know that much, huh? Cash flows are divided up into three categories, which you already know from earlier in the course, but let's go over them again because they're mucho important as we go forward. Operating activities, operating cash flows, inflows and outflows directly relate to earnings from the normal business. I'm going to use my favorite example of Coca-Cola. They make soda. They make money by producing and selling soda and their snack foods and their waters and juices. That's the operating cash flows. Buying inventory, paying their employees, paying suppliers, recording sales, collecting cash from customers, operating. It's the core business. But I would say just about all businesses look forward to an investing opportunity if they can. And in this chapter, the two investing opportunities we're going to be talking about would be a company buying stock in another company or another company's bonds, or purchase of a fixed asset. You buy a big $500,000 machine or something, that is an investing activity. Financing activity, substitute the word borrowing for financing, and that's pretty close to what it is. You're borrowing money, you're issuing a note, or you're going the other way by issuing stock to the public. Those are financing activities. Any dividends that you pay are financing. Wow, look at this. This is a completed cash flow statement. I'm going to take us through this briefly just to get you dividing and conquering a little bit, and then we'll go through it in some detail. A cash flow statement is going to come up with those three cash flows that we called operating, investing, and financing. And when you add those cash flows up, they must equal the difference in cash between 2 months. In this period here, the cash at the beginning of the month, I'm on the bottom here, cash at the beginning of the month was $18,267, and it went up to $29,932. Therefore, the cash flows have to equal that amount. Here's what we're talking about, dividing and conquering. You have three sections: the operating section, the investing section, and the financing section. Always, we're going to start with the net income, and to that, we are going to add depreciation expense or amortization. The reason for that is those two expenses are not cash oriented. They have nothing to do with cash. So in essence, we're changing this accrual-based net income into a cash-based net income. Not included here, but I want to talk about it. Any gains we may have had in the form of selling a fixed asset would have to be subtracted from the net income in this section. The reason being that net income from selling the asset is already included in our overall net income. So it needs to come out for purposes of the cash flows. Here we go. We add that. Now we're going to go to our balance sheet, and we're going to look at all the current assets and liabilities that are operating. Accounts receivable, inventory, prepaids, accounts payable, accrued expenses. And you notice these numbers represent the difference at the beginning of the year as opposed to the end of the year. It represents the change in these assets. And you notice that accounts receivable has a positive 5864. That tells the world that accounts receivable went down, okay? When a current asset decreases, that is a positive cash flow, and the opposite, a current asset that increases is a negative cash flow. And let's think about it together. Accounts receivable. Accounts receivable goes down only when somebody pays us. That's a positive cash flow. Accounts receivable increases when we bill somebody and we're not getting any cash. We temporarily gave away the product. That's why that's a negative cash flow. So to get your cash flows from operating, it's really three pieces: net income plus the non-cash expenses minus any gain or loss on the sale of a fixed asset, and these changes in those balance sheet items. This section here is the hard part. Now we're going to go into investing. Investing, you have to go into your general ledger and pick the bones. You have to look at the general ledger, and you're going to see different entries, and those entries need to be listed here pretty much one by one. Investing, this company has a negative cash flow because they purchased a lot of equipment. They sold a little bit of equipment, and they had some activity with short-term investments where they had a cash outflow. They bought them, and here they have a positive cash inflow where they received funds. In this section here, investing and financing, there's no figuring to do. You will be given those numbers, and it's just a matter of knowing that they are financing or they are investing. I distracted myself. Let me get rid of this thing here. Okay, we're into the world of financing. Well, they paid back some debt. That's clearly financing. They purchased treasury stock. That is financing. And if you pay dividends, like I said, that is a financing activity. So let's see if we can make a little sense of this going forward here. Yeah, come on, this thing doesn't want to. Starting to get flop sweat with this stupid computer. Here we go. Cash flows from operating. We kind of know what that is now, right? Dealing with our customers, with our employees. Maybe we invested in another company, and that company paid us dividends. The investment in the other company is an investing activity, but the dividend and interest are operating. Kind of a little trick there. Cash outflows. We buy things, we pay people, we pay taxes. Cash flows from operating activities. Cash flows from investing. Inflows. Hey, we sell some old equipment. We sell a bond we purchased. We sell stock. Outflow, we buy these things. We buy stock, we buy a bond, some kind of security. We buy a forklift. Financing, like I said, pretty much raising money by borrowing or issuing stock. Cash received from borrowing or issuing stock. And then the outflows, of course, would be when you're paying back your bills, your notes payable, rather, or bonds payable. You repurchase stock in the form of treasury stock. Now, dividends paid to owners, this would be a financing cash flow. And they're just summarizing it here. And let's understand what the goal of this game is here. We're going to say that the beginning cash was 18,267. It rose to 29,932. The difference is 11,665 positive. And when you're sitting down with the boss, you say, hey, boss, we generated 53. And since this is a big company, National Beverage, this real number here is 53,269,000. And then he'll say, how come you only ended up with 11.6 here? And you have to remind your boss, he or her, well, don't forget, boss, we invested, and then we finally had to pay that big bond issue we took out some time ago, okay? In order to prepare a cash flow statement, you need three things, we'll say. You need two balance sheets, because you're going to be working with the differences in those balances. You need the income statement for the current year. And when it comes to the sections financing and investing, the details have to be provided, either by telling you in hopefully simple terms or by providing you with copy of the general ledger. And you can dig it out that way. That's why I call it picking the bones. These items we're going to skip. Here's our information we just had. There's our 11,665, the difference here. So this is called a comparative balance sheet. We have one. I love this. They've got 14 and 13 over the top, but I think this is 14. Yeah, that has to be 14. This is 13. Another goofy slide. So that's what we're going to start with. And there's their income statement. They're saying they had income of 43635. You remember that number? We had that on our cash flow statement. And let's go looking for any depreciation. And here it is, 10,063. So by adding the 10,063 to the net income, we're going to come up with what we're going to call the cash net income. Direct method, I'm only going to go over that briefly, but not in this environment here. Nobody uses the direct method. It's a simple regurgitation of the cash general ledger account. The indirect method is what we're talking about. This is what the world uses. This is what's required on financial statements, along with the appropriate notes. And as we learned, we start with the accrual net income, and we convert it to cash by adding non-cash expenses. Any gains have to come out with gain on the sale of a fixed asset has to be subtracted or a loss added for the reasons we mentioned earlier, plus and minus your changes in current assets and current operating liabilities, Here is a little explanation on why we have to subtract any gains from the sale of a fixed asset, because this gain is already in our overall net income. If we didn't take it out, we would be double counting it, and we would not be able to tie out our cash flow statement. I'm going to skip that. So here we go. We're taking a look here at the two balance sheets. Here are the differences, okay? Cash, as we know, went up 11,665. Short-term investments went down 980, and accounts receivable, we mentioned, went way down 5864. You're starting this project by getting this part done. And then, having done that, you're going to start bringing some numbers over here. We know we start with the net income, and we know we add the depreciation. But getting a little ahead of myself. But look what they're doing here. Here is the balance sheet. Okay, these are different numbers, Okay. There's their balance sheet. And now we're still with National Beverage Company, but they're giving us different numbers now, which is okay. We can improvise. We can do it. So here's a balance sheet. Here are the differences. There's the income statement we're going to be working with, 24,742. Cash changed by 32,643. Let's see what we do now. Here we go. First step's not too hard. You take the net income plus your non-cash assets, amortizations, maybe even have depletion in there. And we go from there. We now go and pop in all of the differences in our operating current assets. Where did they get these numbers? I see 4,549, 858, negative cash flows. Where did they get that? They got it from this balance sheet here. There you go. What did we say? If an asset goes up, it's unfavorable. If it goes down, it's favorable. So let's go back and take a peek. inventory, prepaid expense. Now I'm going to go back up to the balance sheet one last time here to talk a little bit about current liabilities. We just learned that an increase of an asset is negative. An increase in a current liability is a positive cash flow. Accounts payable, accrued salaries, whatever you have in there for operating, an increase in the liability account is a positive cash flow because we're not paying anybody. If the accounts payable increases, that's a positive cash flow. If we pay people, that's a negative cash flow. So accounts payable just follows the normal sign control. And here we go. There is our number for operating activities. And like I said, this is the hardest section. You master this, you should be in pretty good shape. I'm going to skip that. This is important, huh? And you've probably heard this, and maybe common sense tells you it's reasonable. A company can have a nice bottom line net income, but if the cash flow is negative, that's a real no-no. You got to be very careful. A company could have a nice net income from a one-time sale of a fixed asset or something, and their operating cash flow is dreadful. When you're looking at cash flows, you want to see the quality in your operating cash flows. And what it says there is real true. Investors are not going to invest in a company if they don't think the cash generated from operations is sufficient. You invested in a company hoping for some capital gains, maybe in the hope of selling it in a couple of years, and maybe scooping up a few dividends while you're holding it. If you don't think that's going to happen, you're going to stay away from that stock. Also, no one's going to lend you money. Banks aren't going to loan you money. Investors who do own your stock are going to be dumping it, further exacerbating your cash flow woes. International. Okay, we're back to our famous balance sheet. I see they have changes here in contributed capital and retained earnings. 645 and that number there, 24742, which happens to be our net income. That just means that there were no dividends declared, and the only change in retained earnings naturally would be the income. So here we go. Now, when we get to this nice little yellow section here, we have to pick the bones, meaning you need to know the detail. So we must report individually, both the proceeds in and the proceeds out. Proceeds meaning cash, of course. They're giving us the number. The company purchased new equipment for this amount, 6658, and they sold some old stuff for 167. How does that get presented here? Not too tough, huh? You have a line called purchases and proceeds from disposals of fixed assets. So that's part of their investing cash flows. Now, let's see what it says about short-term investments. Remember in our balance sheet, I'm not going to go back to the balance sheet, but if we go to the balance sheet again, you're going to see that the difference in short-term investment, which is a current asset but not operating, was $3,000. We're not going to just bring that $3,000 over there. We got to put the elements. So here we purchased 109,450 shares of Merck, and we sold 112,450 of Pepsi-Cola, just to pick two companies. We're done with the investing section. Not too tough, as long as you realize they're going to give you this information. Free cash flow. Okay, now we're doing the investing section, right? Or financing, rather. Contributed capital. Contributed capital. That could be an owner put his own money into the business, or more likely, they issued stock. So let's see what we have here. The net increase in contributed capital was the result of two things. They repurchased some of their outstanding stock, known as treasury stock, and then they issued another 950 in shares. The net is the 645. The net increase is the 645 that we saw in the balance sheet right here. And continuing, we put that in, and look at this. We are done with this thing. This is a big report. It's rather daunting when you first look at it. I remember when I took the CPA exam many years. You know, my goodness, it's been almost, holy cow, it's almost 40 years. Some of you were not even born, I bet, huh? The one thing that scared me was, please don't put a big complicated cash flow statement. And when I opened up the envelope, the first darn problem was exactly that. Cash flows from financing. The long-term growth of a company comes from three different places, huh? Internally generated, borrowed, or issue with stock, and they're repeating this. They are repeating this slide here. And we're not going to go into the supplement, nor am I going to talk about the direct method. So what I'm going to do is go back again to the beginning. And I'm just going to make a few points to all of us, if I can get back up there. Looks like I have to go back the long way. There we go. Here's our cash flow statement. And let's concentrate on operating. These numbers here are simply the differences between the two periods, the beginning of the month and the ending of the month. And I'm going to finish up here by pounding into your brains. And by the way, I want to again thank you all for cooperating with this awful online system we've had to install here. Those differences are there. Short-term investments, let's go to receivables. Receivables went down, right? Went from 64, it went down, so that's a favorable cash flow. Inventories went up, as did prepaids. That is a negative cash flow, okay? Liabilities, if it goes up, it's good. If it goes down, it's bad. Think in terms of cash. In fact, that's what this is, the whole chapter on cash flows. If receivables goes down, that's a positive cash flow. It went down because we got paid. If accounts receivables go down, that's a terrible cash flow because we spent money. And those are the relationships I think you need to get familiar with. So I hope this helps. I hope you're going to be at our. I hope you're going to be at our class tonight, 5:30, where I'm going to go over this again and get you guys ready for the final exam. Okay. Well, thanks again for hanging in there with me, and we will see you later. Bye-bye. I said bye-bye. Bye-bye.